Europe continues to take centre stage in market developments. Clearly, when we started the week, Greek bonds were trading at very inflated levels, and the question mark over how the debt was going to be restructured, rescheduled, or indeed whether there would be a default was very much amongst traders' minds. So we certainly saw a very weak start to equities across Europe on Monday, but I think it's fair to say that as the week has progressed, more confidence has come back into markets, and they're starting to look at the more positive things going on at the moment, despite the fact that the Greek situation still remains largely unresolved. So let's just take a look at what is happening in Europe at the moment. This first chart that we're looking at, which I have shown before, is the status of Greek bonds, and as you can see, that very, very tall spike that occurred during the course of mid-April has plateaued somewhat, but with yields on this debt trading at around 15.5%. Clearly, these are very unsustainable levels, and hence the need for this restructuring. Now, from what I understand, short-term loans to Greece still remain quite fluid, and rollovers there are taking place on a fairly regular basis, but how Europe does deal with Greece is going to be, I think, a very key indication of what they will ultimately have to do, possibly with Ireland and of course with Portugal. And Spain is the one country that nobody wants to talk about in the same context as those two countries. But all of these developments in Europe still leaves the euro trading reasonably strongly. This is a very short dated chart I was showing here. It shows the euro versus the dollar, and as you can see from the latter part of last week, when these Greek issues were most concerned, you can see some slippage there in the value of the euro versus the dollar. But really, again, just continuing that theme for Tuesday, Wednesday, Thursday and Friday of this week, the euro has held steadily. And I think, just to give an indication of the things that can drive the euro, we had some very good GDP numbers out from France. We know that Germany is doing very well at the moment, and I think it's those more positive angles that continues to hold the euro in good stead. So as I say, this is still ongoing work. We still expect to see Greece come back to the fore as we see the decisions coming through, but a largely comfortable week for equities. Now, the other key feature of this market has continued to be commodities. Commodities have suffered a very sharp fallback, which we commented upon last week. There was a rally, but it proved to be short-lived. The rally has petered out, and you can see here that commodity prices are back down on those lows at the moment. This chart here is the CRB, so it's a basket of commodities, so I'm not individually picking out individual commodities at this stage, but really just giving an overview of what's happening at the moment, and just the speed of which that rally has petered out suggests to me that we may see a further decline in commodity prices in the very near term at the moment. So on one hand, that could be quite helpful for inflation worriers, those that are concerned about the inflation impact in the second half of this year. But maybe this is giving a little bit more credibility to Mervyn King's comments recently about expecting inflation to come back. Certainly inflation forecasts at the moment are not building too much downside to commodity prices, so there may be an element of surprise there. That, as I say, if that does happen, we may see some weakness in commodity stocks, which may impact on the FTSE 100. Again, much tougher than maybe the US comparisons. Just coming back to some businesses that I think have featured this week. In the US, we saw a very sharp fall in Cisco shares. This was on the back of their trade report, which indicates that this business, whilst operating in some quite high growth markets, Cisco operates looking at areas such as broadband growth, so demand for video content across the web continues to push out the requirements for more infrastructure spend in broadband, but Cisco themselves have more fundamental issues within the business, and there are going to be some redundancies, some very, very sharp cost cuts within that business. This was a negative surprise to shareholders of Cisco, and that stock, as I say, was a big faller on the week. On the more positive side for technology, we did see Microsoft spend $8.5 billion on Skype, So far, nobody's been able to justify why they're spending $8.5 billion on that business at the moment, particularly as it was sold to the current management team for about $5 billion less, literally within the last couple of years. And finally, just in terms of one or two of our covered stocks, I wanted to highlight Serco. Serco and Capita both operating in the outsourcing market. Serco we have a buy note out on. They had a very good jump on the back of results that came out this week. Overlying concerns has been whether or not the government is going to engage as widely as hoped with some of the outsourcers and moving some public sector work into the private sector work as a route for cutting costs. A BBC report did identify that they may be going slow on that particular process, and that has weighed on the outsourcing sector. But the results this week proved to be quite pleasing. The commentary certainly from Capita was pleasing as well. So both of those companies have had a better week this week following sort of recent disappointment.